Hello everyone, and welcome back to another episode of MonsterInvest. I'm your host, Daniel, and I am thrilled to have you with us today as we embark on a journey through the treacherous yet rewarding landscape of the financial markets. Have you ever walked into a glitzy, high-energy casino, perhaps in Las Vegas or Macau, surrounded by the ringing of bells and the flashing of neon lights? You walk up to a slot machine, put a single coin in, pull the heavy lever, and boom, you win immediately. That sudden, electric rush of adrenaline shoots through your veins. That warm flush of validation washes over you. It is a dangerous feeling, isn't it? It is that seductive whisper in your ear suggesting that maybe, just maybe, you have the magic touch, that you are special, that you have cracked the code. It is intoxicating because it bypasses your logic centers entirely and plugs straight into your ego. Now I want you to imagine that exact feeling, not just lasting for a few fleeting minutes on a casino floor, but stretched out for 3 whole years. You buy a stock and it goes up. You buy a crypto token with a funny name that you've never heard of, simply because a stranger on the internet mentioned it, and it doubles overnight. You look at your portfolio on your phone, first thing in the morning while the coffee is brewing, and the last thing at night before you sleep, and all you see are green numbers. You start to think, this investing game is easy. Why did people say this was hard? I might actually be a genius. You start planning vacations to the Maldives you can't afford yet, based on money you haven't even cashed out. This is what economists call the wealth effect in action, and let me tell you, it is the most potent and addictive drug in the financial world. And then one day, without warning, the music stops. The lights turn on, revealing the stained carpet and the tired, pale faces around you. The bartender tells you to go home, and suddenly you look around the empty room and realize you aren't a genius. You were just riding a bull, and bulls eventually get tired. They always do. Today we are going to dive deeper than we ever have before into the two most powerful, and often misunderstood, beasts in the financial jungle, the bull and the bear. We hear these terms thrown around every day on CNBC, Bloomberg, or in Twitter threads, but do we really understand the mechanics behind them? Do we understand the seasons of the market? Because just like farmers can't plant crops in the snow, investors can't use summer strategies in an economic winter. But more importantly, today we are going to stop guessing. I'm going to give you the specific tools, the dashboard indicators, that tell you when the weather is changing, so you don't have to rely on your imagination or your emotions. To help us understand this better, let me take you on a journey. I want to introduce you to a fictional friend of mine. Let's call him Alex. Alex is a smart guy. He's a senior engineer, logical, good with numbers, and rational in his daily life. He has a stable job, saves some money every month, and feels financially responsible. It is the middle of a roaring economic boom, a classic bull market. Now remember, a bull market isn't just a good week. It is defined by a sustained increase in prices, usually rising more than 20% from recent lows, often driven by a strong economy and high employment. So Alex enters the market. The backdrop is perfect. Optimism is high. GDP is growing faster than expected. Corporate earnings are smashing records quarter after quarter. Everyone is happy. Alex buys a popular tech stock. Let's call it future tech. 2 weeks later, it's up 10%. He feels a surge of dopamine. He buys more. It goes up another 10%. Now psychology kicks in. The greed takes the wheel, accompanied by its annoying cousin, fear of missing out or FOMO. Alex starts looking at his boring savings account earning almost nothing and thinks, why is my money sleeping there when it could be working here? He moves everything into the market. He feels invincible. This is what we call the markup phase. It's the party phase. Alex ignores valuations. He ignores risk. He is chasing momentum, believing that the tree will grow to the sky. But markets breathe. They inhale and they exhale. And just when the party is loudest, just when the optimism is at its peak, the cycle shifts. We enter the distribution phase. This is the most dangerous phase because it is tricky. It's invisible to the untrained eye. The news is still good, but the prices, they stop going up. They go sideways. Why? Because the smart money, the institutional investors who bought in years ago, are quietly selling. They are distributing their shares. They are handing their expensive shares to people like Alex who are just arriving at the party, desperate to get a piece of the action. Then the bear wakes up. A bear market is defined by a drop of 20% or more. The market drops. Alex buys the dip thinking it's a bargain. It drops again. Alex denies it, thinking it's just a correction. It drops again. Alex panics, and finally, right at the bottom, when the pain is unbearable, Alex sells everything. He capitulated. He bought high on greed, and he sold low on fear. But wait, how could Alex have known? Is investing just a guessing game where you hope for the best? Absolutely not. While Alex was trading on emotion, another investor, let's call her Sarah, was trading on data. Sarah didn't use a crystal ball, she used a compass. She watched specific indicators that flashed warning long before the crash happened. So what are these indicators? How do you spot a bull turning into a bear without relying on guesswork? I'm going to share with you the 4 key signals that Sarah used. The first thing you need to look at is the 200-day moving average. This is the granddaddy of trend lines. It smooths out the last 200 days of price action to show the long-term trend. It is simple but powerful. If the market price is above the 200-day moving average, we are generally in a bull trend and you can be aggressive. But if the price crosses below it, watch out, the bear might be waking up. Sarah saw the price slice through this line like a knife through butter, and she knew it was time to get defensive, while Alex was still blindly buying. The second signal to watch for is called the death cross. This sounds dramatic, and it is. This happens when the short-term trend, usually the 50-day average, crosses below the long-term trend, the 200-day average. It signals that momentum has officially shifted from positive to negative. Conversely, when the short-term crosses above the long-term, it's a golden cross, signaling a potential bull run. Alex ignored this technical breakdown because he was listening to the news, but Sarah respected the chart. The third indicator comes from the bond market, and it is called the yield curve. Normally, long-term bonds pay higher interest than short-term bonds because you are locking your money away for longer. But sometimes this flips and short-term rates become higher than long-term rates. This is called an inverted yield curve. Why does it matter? Because an inverted yield curve has successfully predicted almost every recession in the last 50 years. It is the economy's check engine light. When Sarah saw the curve invert, she knew the economic winter was coming, even if the sun was still shining on the stock market. And finally, you should check the VIX index, often called the fear gauge. This measures expected volatility. In a bull market, the VIX is usually low, below 20, meaning investors are complacent and comfortable. When the VIX spikes above 30 or 40, it means fear is gripping the market. Alex sold when the VIX was at 40, which is maximum panic. Sarah was buying then, because as the old saying goes, buy when there is blood in the streets. So how do we navigate these cycles using these tools? What is the practical strategy? If you identify that you are in a bull market, your strategy is to let profit run, but keep an eye on that 200-day moving average. As long as we are above it, stay invested, but don't get cocky. Watch out for euphoria. When your taxi driver gives you stock tips, or when your friends who never invest start talking about crypto, that is a contrarian indicator that the top is near. However, if the indicators shift and you find yourself in a bear market, your strategy must change to capital preservation. Cash is king. When the death cross happens or the yield curve inverts, it's time to rotate into safety. Move into defensive stocks. These are companies that sell things people need, not want. Think healthcare, utilities, and consumer staples like toothpaste, soap, and electricity. These companies tend to hold their value when the economy tanks because people still need the basics. And for the long-term investor, the best strategy in a bear market is dollar-cost averaging. If you have a 10-year horizon, a bear market is actually a gift. It's a clearance sale. Keep buying quality assets every month regardless of the price. By doing this, you are lowering your average cost per share, setting yourself up for massive gains when the bull eventually returns. To summarize everything we have discussed today, the most important lesson is not to be like Alex. Don't trade on feelings. Don't let your ego drive your financial decisions. Instead, be like Sarah. First, identify the phase by asking if we are above or below the 200-day moving average. Second, watch the signals. Has the yield curve inverted? Is the VIX spiking? And third, adjust your strategy accordingly. Be aggressive in bulls and defensive in bears. Investing isn't about being right every time. It's about surviving the bad times so you can be around to profit from the good times. Thank you so much for tuning in to Monster Invest. If you found value in this episode, please do me a huge favor. Smash that like button. It really helps the algorithm find more people like you. Share this episode with a friend who might be blindly riding a bull right now because you might just save their portfolio. And if you haven't already, hit that subscribe button and the notification bell so you never miss an update on how to master your money. Keep your emotions in check, keep your powder dry, and I'll see you in the next episode. This is Daniel, signing off.